Next, we go down the list. Here we have the following inverted gap. The price breaks through it and touches it, rolls back for what I am saying, corrects and grows again. That is, the structure is broken through here, then the structure is broken through here. There is another block order here. It was broken upwards. It became valid. The price touched it, and the price flew further. But this formation is formed on the gap. This whole formation is also formed on an inverted gap. This order block is formed on the middle of the 15-minute shadow of a large candle. That is something that tells us where the price will move next. And there is a certain logic in it all. This is the movement was with a snapshot. This is the liquidity. If you look to the left, there was also liquidity. And the most important point, why didn't I consider this gap? When liquidity is taken off, the probability that the price, let's say, will come to this very first gap is very low. That is, when everybody has seen this growth and everybody starts to see a super obvious block order, then more often than not, it does not work. I mean, as my rule, when liquidity comes off, I don't re-enter right away. I need to see some degree of correctivity and then again see confirmation. Confirmation in what? At least a breakout of the structure, an inverted gap that gives support for price movement, a block order. That is the most important thing. We have the main goal, liquidity. That is, if there was no liquidity, it would all be just random. But when we have liquidity and we understand what is happening, we can work in this format. That is, liquidity was removed here. And we have a downward movement. We have one more gap, let's say, for example. I personally, for example, do not go in right away. That is, I set a limit and it will not work there. I look for confirmation, that is, I watch how these smart money elements react. Specifically here, order block. It could be breaker. It could be gap. It could be inverted gap. I just look at their reaction and then I bet on where the price will move next. So here we touch this order block and start to grow upwards. Okay, let's say that here again you would be afraid to enter the market. What I see next is that the price is pulling back. Where? It's pulling back to the gap. This is the most important thing. It fixes itself inside this gap with its bodies. It does not cover the gap with its bodies, and then it does not roll back there. It strictly respects the gap. So it is very important. These smart money elements, if you count on the fact that there will be an upward movement, they must be respected. That is, they should not be broken through. They should not be completely taken out of the market. The price should give a soft, logical reaction to them that is providing some support. And specifically the bodies, let's say they give the most reliable information because they contain the largest volume. And shadows are, let's say, for manipulation, for confusion. Here it was clear that this HEP withstands after this candle, which broke through this candle. Yes, this is M1, for example. If you look at 10 seconds, there would be a break of the structure upwards. There would be a break of the structure, and you could enter. And again, there are several context factors. So we have this order block. We have this dotted line, which is the middle of the shadow, and the candlestick on M15. We have a gap. We have a breakdown of the structure here. We have something like an order block here. And in fact, you can walk here, you can enter here, because you know that the price is attracted to liquidity. That is, you do not need to strictly just there at the top of the block. Order stop loss is pulled up. That the maximum profit was no. In other words, the coolest and most effective way is to follow order flow. What I'm showing you now, all these elements, interaction, this is order flow. This is the real market structure. That is how the price is formed, logic, smart money, every element is worked out here, and this is time frame M1. In fact, we are framing the context. I showed you the history on H4, where the liquidity is, where we find support, and I showed you some reference points, which are on M15. And already, when we've marked up some important time frames, then we can go to M1. It could be M5. There's just super cool scalper trades on M1. But again, you have to be careful with that. So unless you have some sort of higher probability system, then be very careful. And again, what I am telling and showing you now is not a call to immediately get into the market and think that you can easily repeat it because you have watched the video once. You need to spend tens, hundreds of hours watching the price, how all these movements are formed, how each block gives a reaction, how each gap gives a reaction. What was the context? Write it all down, document it. Very painstaking work if you want to learn to read the market with such jewelry. There was a huge amount of movement from 1637 to 1747. Yes, that is an hour. 10. Here was 1 entry point, 2 entry point, 3 entry point. That is 7 entry points you could potentially earn. Even here it was necessary to enter there some 1, 2, 1 to put stop loss here and exit here. And that could be taken away because there is the main reason for the movement above. It is liquidity and the base, which on H4 or on M15 I also showed. That is a certain context. When you have this context, you can work on order flow and move with the market. But again, what is the main point here? If you want to bet that the movement will move up, you need to watch how the price behaves on a smaller time frame. It depends on how you trade. So if you trade intraday, you can find confirmation on M5, M1, and just watch the price. So if you have two things in your mind, the price has to bounce off something. You have to rely on some elements. The price at the bottom, for example, will either take liquidity off, or it will close the gap, or it will hit a block order, or a breaker. So there is some basis that the price cannot pass. And there's a magnet at the top that will attract the price. That's liquidity. And so in those two main reference points, you find elements of the smaller smart money time frame. And repeat the same thing. Right here is where the order block prevents the price from going lower. It's giving a reaction. It rolls back. Here there is an inverted gap. Here there is an inverted gap. Then further breakout of the structure for what I said. So at the base, a top, a pullback, a breakout. And again, it's momentum, correction, momentum. Here's a correction. From here, momentum again. You use absolutely different elements with different skills, different understanding, different knowledge, different experience. That is what I showed you at the beginning of the video. It's the easiest. You can figure it all out within a day. This requires painstaking and serious work. You should not be in a hurry, but you should strive to watch the price. The more hours you spend looking at charts and forming hypotheses, as I have just shown you, even on history, and either when you watch it all in real time, it should be documented, and every day you should watch small elements on history, how they are traded. And when you have seen tens, that is hundreds, thousands of times, how this or that order block works out, or what was the pattern of gap and breaker, or order block, or inverted gap, and you realize that the price goes here. When you have looked at it all on the history, when you have looked at it all in real time, you just develop a skill of perception. So you understand how it works, and it works that way. And then you can easily apply it in real time. That is, you can trust it, you can rely on it, and only then there will be quality results. If you have not seen how it works, you have not just watched the price, then there is a very high probability that you will freak out. You will be kind of taken out of the market. That is, I'm almost sure that most of you will watch this video and immediately run to the demo account to check it all out. But before that, you need to spend a long time, really months, on it. But in fact, a number of months is not such a big price to pay in order to understand how it all works. But these elements of price movement to a particular liquidity are the order flow. That is, you observe the smallest components of the smart money and either support your hypothesis or refute it. For example, the majority could put the following element here. Yes, there is a gap. The price will close. It is liquidity again. There is a gap and the price will go down. Let's say you would enter somewhere here to sell. But here it would be clear that your hypothesis with a gap does not work. And this gap, from which you would like to short, now turns into an inverted gap. And you either close the trade immediately and re-enter and earn profit. But the majority of traders remove stop loss and wait for the price to take out and kill their account completely. This is the main mistake. When you can trade such small elements, then and only then you have clarity. Clarity, jewelry entries, and all these elements, they are repeated absolutely on different time frames, but most often it is cool to find deals within the day on 1 minute, 5 minutes. This is something that works very, very cool, but you have to be very careful with it and do not hurry to go through it with the help of this history, because you need to sharpen your perception first. Just learn to read. Friends, here is another example of an impulsive movement in the quest for liquidity. Again, I would like to emphasize that it is very interesting to consider impulsive movements, not to trade some consolidations, manipulations, but to try to make everything so that the system was built for impulsive movements, not pullbacks, not corrections, not consolidations, but impulsive movements. This requires several elements. Again, I repeat to you, they need to be detailed. There must be some base from which the price will rebound, on which it will find support or resistance. And you need a clear magnet. If you can find and notice these points through your analysis, for example, on the weekly, hourly, then on the M15 time frame, you need to wait for the price to get there. It's exactly not just open a chart and trade what I see. Well, let nothing is clear, let the probability is low, but in short, I entered the market. No, this approach does not lead to anything and can never lead to anything. The approach that I am showing you works in smart money. These are the most highly probabilistic trades, and in order to determine them, you need to analyze several time frames. Ideally to look at the weekly time frame where the potential development of the weekly candle can be. That is, on the weekly time frame we basically orient ourselves to what larger global points the price is moving. It is like our long-term view of things. At 4 hours and at the hourly time frame, we can operate with elements that will allow us to find qualitative, profitable points within the day. This is what we need. And if, for example, on H4 or on H1, you find two important elements. That is, you realize that there is liquidity, to which the price will move either gap, and there is support in the form of gap or order block or breaker, something that will not let the price move further. Here we had consolidation, then there was an impulse movement, then there was consolidation again, then there was a pullback, and here we had consolidation again. And the question is where this consolidation occurs. Here we have an hour gap, and here we have an order block. The price touched it once and did not rebound 2, 3, 4. And there is not a single touch with the body. The body does not enter this order block. This indicates that this point can potentially hold, and accordingly, it will launch the price somewhere else. And at this moment, you immediately mark out a potential level where it can move. So here we have a gap, and the most interesting thing is liquidity. That is how it looks like on the hourly time frame.